Well, welcome to the Economist Board for our January 2024 Watch Report. I'm John Nelson. I am not Patrick Mahomes, but I'm doing my best imitation of him from M&A, and I'm joined today by Keith Prather of Armada. How you doing today, Keith?
Well, I'm doing. Sounds like a little better than you, maybe. So,
Yeah, maybe a
yeah,
little bit better. I'm on the back end of that cold, but we're going to make it work.
there you go.
Okay, so in our videos today, we're going to provide some additional context to the models and the narratives that we put into the watch. We're going to focus specifically on industrial production in this video. And then for those who are subscribers, we're going to dive a lot deeper into the subsectors of manufacturing, transportation, provide a macroeconomic outlook, as well as hit the construction sector. And since consumer spending is 70% of overall GDP, we're also going to take a look at advanced retail sales as part of our macroeconomic look. If you're not a subscriber, it's time to sign up. Times are really interesting, and Keith's going to talk about some of that as we lead off with this industrial production look.
Yeah,
So, Keith,
John,
you ready to get
Real
going?
fast, not to interrupt you, but I'm going to interrupt you for 1 second. I mean, the free trial to the watch is so simple. I mean, it's a 60-day free trial. You get the reports, you get everything, you get all the extra videos. I hate to make this commercial, but we have to, right? It's so dirt cheap. The trial is free, and we don't collect anything. We just get enough information from you to be able to send you the reports. But after 60 days, it just goes away. We don't collect a credit card or anything. If you do nothing, nothing else happens. So it's risk-free. Just try it.
So it's so easy, even a caveman could do it.
Oh, I wasn't going to go there, but you went there.
I,
Absolutely.
absolutely.
Absolutely. I love those Geico commercials.
Yeah,
Yeah.
we're going to get a call now.
Yeah, we are going to get a call, right?
All right, so let's get going. I'm going to go ahead and share our industrial production model. And you seeing it there, buddy?
I am. Yep, you got it.
Okay, great. So as you can see, we're telling a real similar story to last time, however, with a slight improvement. You still have this rise over the next 6 months. We've been calling for it, although it's extending a little bit further than what we were calling for before. But we're still calling for it to generally increase out to about July-ish before we start seeing a general tapering off. But that general tapering off is only going to take us down 18 months out. That's a long way out. But at 18 months out, we're still calling for it to be pretty close to where it is right now. So if anything, you can look at this as a pretty flat forecast for the next 18 months. Previously, we were calling for a bit of a downturn, on the back end. Now we're calling a little bit softer landing, if you will. And so if you take a look at the long term, what does that look like long term wise? Well, it puts us pretty much right on trend.
Yeah, absolutely. And some of these things that we've been talking about over the last 6 or 7 months, we've been watching them, and we don't have slides on them in this particular deck, but we've been watching inventory ratios around the United States, which actually creates and drives the demand for manufacturing output. Inventories have been bloated, and so companies haven't been reordering as fast. And as a result, then we've just got kind of this kind of fits and spurts of growth. And so it is fascinating, John, when we look at some of the macroeconomic forecasts from the Federal Reserve and the Conference Board and a lot of other entities, they're kind of showing first half sluggishness followed by second half growth. And a
Mm.
lot of our curves, we go through all of the models and we look at all the subsectors and we look at all of our macroeconomic stuff. What we're seeing is a little bit of a reverse, where for the manufacturing sector, we're seeing just a little bit of first half recovery, which you see here in this chart, followed by what we'll just call a swoon, right? It's a little bit of softening in the back half of it. But you pointed out many times, accurately so, if you look at the recession indicators, which is the gray bars, this doesn't represent anything close to, even a shallow recession. This is calling for more of what we would consider maybe a soft landing. Soft landing means that, the Fed and others have engineered things such that we kind of come into just this, slower growth rate, but not recessionary. And that's kind of what this is calling for.
And I read this morning that the conference board has even changed their tune a little bit on it.
Yeah, and we'll talk about it more behind the scenes in the macroeconomic forecast. But Q4 just came in a lot hotter than expected.
Hmm.
We grew up about 3.3%, and there wasn't anybody in the country, Federal Reserve, Conference Board, nobody had hit that number. Everybody was calling for something between 1.5% and 2% growth. So it was a blowout number. Now we'll get 3 more revisions of GDP for Q4, and so we may see it adjust down. But in the macroeconomic video that we're going to do here in a couple minutes, I'm going to break down where the growth was in Q4, and it's just a little bit suspect, just a little. I mean, consumer spending was very strong, but I'm going to tell you 25% of consumer spending in Q4 was in RV sales.
Wow.
Come on. Yeah. I mean, there's a lot of people now kind of questioning the data just a little bit. It's like, are we really, really capturing it accurately? And, no one's saying manipulation, but there's just a lot of questions about what we're looking at.
I
So
haven't seen that many Winnebagos on the road.
I know, right? Right. And we actually do work with the RV, with an RV dealer association, and they're not singing the same tunes. I don't exactly understand the data, but anyway, that's a different video coming up in a little bit.
Sure. All right. So that's how we're looking at the overall industrial production. Let's take a look at what, the kind of the supply chain of raw materials coming into it. First, do you want to look at fabricated or do you want to look at primary first?
Whatever you got teed up first. We'll go
Okay,
that way.
let's go ahead and we'll take a look way deep in the supply chain and we'll look at primary metals first.
Perfect.
And, it's remarkably, it looks like the IPMAN chart. You could almost lay these right on top of one another, shift the axis just up and down a little bit. Where these guys where primary metal wants to trail off is maybe a month later than the IP man, but generally the chart looks pretty much the same, and we're not telling that much of a different story than what we did last month. So I'm feeling pretty confident that the model's telling us what's going to happen. Now, overall, for 20 years, this sector has been declining. And the data that I've seen, I was working with the American Foundry Society just recently, and data that I've seen is supporting this, that it's going to be this kind of a continuation of a trend.
Interesting. Yeah, a lot of offshoring, right? And maybe that's part of it. Yeah, this is interesting. You've done a phenomenal job on this model, John. I was just looking over here, and the accuracy rate on this thing, you're batting 99.4% accuracy 6 months in advance. So that front half of that curve, very confident in. And the backside of it, I mean, we know that back end of the tail is going to whip a little bit. And we're going to so it may not be as low as what we're showing here. Or it could be a little bit worse. We don't know. A lot of volatility. So let's go macro for just a second. So we have the Red Sea shutdown, and the Red Sea, we looked just yesterday, and based on normal throughput would be about 150 ships over a short period of time. Right now, we're putting through less than 25 ships, and all of them going through the Red Sea right now are either flagged Russian or Iranian. Those are the only two that the Houthis won't target, and so insurance companies with those kinds of flagged ships will go ahead and let them go through the Suez. Anybody else, just because of the risk, they're having to go down around the Cape of Good Hope. So early on, we really thought that wasn't going to create a lot of congestion, that once we got over that initial wave of ships that had started up the Red Sea, had to turn around and go down around the Cape of Good Hope. By the time they get refueled and by the time they get around the Cape of Good Hope, it's a 21-day delay in transit. So anything that was in transit coming into the beginning of January is now looking at probably a full month to month and a half delay in getting to destination. Most of it's going to be Asia to European trade lanes. But what's happened to us now, third week of January, is we're starting to see global ripples. And the global ripples are stretching out around the entire maritime industry. And now we're starting to see surging maritime prices. I've been watching a thing called the Baltic Clean Tanker Index. And what this is it's basically a measure of the cost to move um, refined fuels, gasoline, diesel, a little bit of kerosene in the world's busiest trade lanes. And that particular measure has jumped. It jumped 17% yesterday, and it was up 8% this morning when we're starting to record. It was fairly flat or down coming into the beginning of January. It's now up almost 88% year over year, and it all has to do with what's going on in the Middle East and around the Red Sea. So there's going to be ripples from that, because you think about that extra cost to move those refined fuels, especially up into Europe, and we'll even feel the ripples down in the United States. We'll start to get a little bit of an inflationary bounce, and
Mm,
that ripples through the whole primary metal sector, cost for primary metals. And what we could see is we're going to think this all the way through, right? If we're sourcing products cheaply offshore from some of these countries in the Middle East, or in Africa, India, Asia, this elongated supply chain and pulling capacity out of the maritime industry drives those costs up. And it could be that we try to source more of these primary metals in the US, which would maybe push this model a little bit higher as we go through the year,
mhm.
especially if that congestion continues. And so I guess the bottom line here is we're seeing a ton of volatility in this, and I don't see enough signals out there, whether it's the Houthi rebel attacks or what we're seeing with the tensions in Iran and through the Strait of Hormuz. Iran's now getting hit by Pakistan, and they're exchanging fire. We've got conflict in Syria, Iraq. There's a lot of issues spreading throughout the Middle East, and the Black Sea is still congested. We had an attack up around St. Petersburg, which has got the Baltic engaged now. And so you've got three primary waterways and thoroughfares for the maritime sector that really is making it difficult to get this global maritime movement happening. So anything being sourced out of Europe, anything being sourced out of Asia right now, it's going to face a little bit of congestion. I was
And
looking at,
if I'm connecting dots here, tell me if I'm right. If you said you might see this thing go up for industrial production, but because we'll be sourcing to the United States, then the PPI, in fact, may rise along with it. Would that be correct?
yeah, that's right. That's right. As long as primary demand in the United States, so demand for products, continues to be stable, and based on the latest data we saw, consumers are still spending, corporations are still investing, some of the durable sectors are still doing pretty good. That's going to continue to create demand for primary metals, and they've got to get it somewhere. And if we're seeing congestion in the global supply chain, kind of come back, then they're going to look for alternative sources, and a lot of those will be domestic, or what we call in the USMCA markets, so Canada, US, and Mexico combined. So anyway, I think that's a little bit of a backdrop here. That's different. That obviously that has changed dramatically in the last 30 days since we've been doing this, which is again why we do the watch and update it every 30 days, why we plug brand new data into the models, why we spit out new results every month, so that supply chain managers and executives can kind of get ahead of it and flex and judge, what the next 6 months is going to look like,
Sure.
because they can do it with certainty. They can use the models with certainty over the next 6 months, and then we get out beyond 6 months, and obviously it gets a little more volatile. But
Absolutely. All right, well, let's take a look a little bit closer in. You have the primary metal, and then you're going to do something with it. You're going to be fabricated. So let's take a look at that one. Fabricated is telling a slightly different story. For the next few months, we're looking at, which is a little bit different than what we were talking about before, a little bit of a decline. But let me put that in context. Look how tight these axes are. When I'm talking a decline, it could be that's less than a point. So essentially read that as flat over the next several months from where we are sitting right now all the way out to May. And then the increase, what looks like a nice size increase, is again, that's only about a point and a half to 2 points on the index. So again, I would read this as fairly flat, which is fairly close to what we were saying before, fairly flat with a little bit of a tail off at the end. Now the tail off is not quite as much as before. And if you look at it, long-term goal, that kind of fits in, or long-term projections, that kind of fits in pretty closely with what we've seen on that long-term trend.
yeah, absolutely. And this particular sector really is pushed or pulled by what happens in some of the other primary sectors that we look at. So if you're on trial or a subscriber, go check out some of the others, because you're going to see different pushes and pulls from automotive, aerospace, some of the machinery sector, and what we see in transportation, all of that pushing and pulling on fabricated metals. And it's almost like the model is kind of struggling over the first 6 months to try and figure out exactly what to make of some of the different readings it's getting out of some of those other sectors. We've got disruptions now in the aerospace industry and supply chain there. Automotive is coming out of the UAW strikes. We've got issues there. And machinery overall, just in general, we've got a boost from construction, but we've got a little bit of slowdown from farming and transportation. And so this is how the model's interpreting that, and when it shakes everything out for fabricated metals, it's seeing again a little bit of that first half swoon followed by an uptick and a little improvement on the back half of it. So
And, and one-
overall, I mean, there's a lot going on right now
yeah.
around the world. I just can't express enough.
And one thing I want to talk about real briefly, Keith, if I could, is taking a look at that long-term trend line. You know, that long-term trend line looks like it's really kind of sloping down, but that's fairly deceiving because that trend line, in the program we're using is being heavily influenced by that spike just right there by 2007.
Yeah.
A better indicator is take a look at where it was at 11/1/2003. It's right about 101. Where was it around 11/1/2022? Well, around 101. So that we're floating around 100. We're within 1 point of where we were 20 years ago. And if you take a look at that period of time in that 2011 to 2018, I mean, it was all hovering around an axis that was sitting right around about 100. So not a lot of real change except for within tight parameters of this overall. Does that
Yeah,
make sense?
absolutely. And you're exactly right. And I'm going to flip it around on you for just a second. And I'm going to
Sure.
say you're exactly right. But look at the recessions. Okay. This is a
Hmm.
great recession indicator metric. And so if you look that 2007, I mean, look at that plummet in the index during that recession, and then also look at it in 2020. It can also tell you that we had kind of a mild transportation recession between 2014 and 2016, and look at how reactive it was. So you're
Hmm.
exactly right when you're calling it fairly flat, because right now this fabricated metal model is not calling for recession at the moment.
Right.
We're not seeing that dramatic decline, that dramatic drop off that would normally precede, an actual recession. So it's actually kind of a cool indicator. And so everything you said is exactly correct. It is flat. Um, and also we'd be seeing more dramatic signals if it was falling off a cliff.
Great.
So,
Okay. Well, that concludes our look at industrial production at the high level, and also taking a look at the feeding supply chain or the upstream portion of the supply chain. We hope you enjoyed it, and thank you very much.
absolutely. Let's go dive into those specific sectors. Thanks,
Absolutely.
everybody. See you soon.